There's something happening right now that should terrify anyone paying attention to financial markets. We're seeing the exact same pattern that appeared twice before in modern history. Once in 1928, 1 year before the greatest market crash ever recorded. And again in 2007, months before the global financial system nearly collapsed entirely. The pattern isn't obvious. It's not splashed across headlines or discussed on financial news networks. But if you know where to look, if you understand what happened in those previous cycles, you can see it forming again. Crystal clear, undeniable, and absolutely chilling. Right now, markets are hitting record highs. Unemployment sits near historic lows. Corporate earnings keep beating expectations. Everyone from Wall Street analysts to your neighbor thinks the economy is bulletproof. Sound familiar? Because that's exactly what people said in 1928. That's precisely the narrative that dominated 2007. But here's what nobody wants to acknowledge. The crash isn't late. It's not overdue. It's building systematically, following the same sequence that destroyed fortunes twice before. And the scariest part? We're not at the beginning of this pattern. We're deep into the middle stages. Today I'm going to show you the 3-stage sequence that has preceded every major market collapse of the past century. How it played out in 1928 and 2007. Why it's happening again right now. And most importantly, where we are in the cycle and what comes next. Before we dive into the pattern itself, you need to understand something crucial about market crashes. They don't happen randomly. They're not caused by black swan events or unpredictable shocks. Every major crash follows a predictable sequence, the same psychological stages, the same warning signs, the same inevitable conclusion. That's because markets aren't driven by fundamentals or economic data. They're driven by human psychology. And human psychology doesn't change. Fear, greed, euphoria, panic. These emotions follow patterns that repeat across generations, across decades, with mathematical precision. The 3-stage pattern I'm about to reveal isn't my theory. It's documented history. It's what happened before 1929. It's what happened before 2008. And it's what's happening right now, in real time, as we speak. Stage 1 is artificial stability. This is when everything looks perfect on the surface. Markets climb steadily. Volatility stays low. Everyone assumes the good times will continue forever. But underneath that calm exterior, massive imbalances are building. Debt accumulates. Risk gets mispriced. Asset prices disconnect from reality. In 1928, this stage lasted nearly 2 years. The Dow Jones gained over 48% while warning signs flashed everywhere. Banks were lending money to anyone with a pulse. Ordinary people were buying stocks with borrowed money, convinced prices could only go up. Sound familiar? In 2007, the same dynamics played out. Housing prices had been climbing for years. Mortgage lending standards had evaporated. Complex financial instruments were spreading risk throughout the global system. But on the surface, everything looked stable. The economy was growing. Unemployment was low. Nobody wanted to hear about problems. Today we're seeing identical conditions. Markets have been climbing for over a decade with only minor interruptions. Interest rates stayed near zero for years, flooding the system with cheap money. Corporate debt has exploded to record levels. Asset prices have reached valuations that would have been considered insane just a generation ago. But here's the key insight about stage 1. The artificial stability isn't accidental. It's created deliberately by central banks and governments who believe they can prevent crashes through intervention. They cut interest rates when markets wobble. They inject liquidity when banks need cash. They backstop any institution deemed too big to fail. This creates what economists call moral hazard. When investors know they'll be bailed out if things go wrong, they take bigger and bigger risks. They leverage up. They chase higher returns. They convince themselves that this time really is different because the authorities have everything under control. That's exactly what happened in both previous cycles. In 1928, the Federal Reserve kept interest rates low to support the economy. They believed they had conquered the business cycle through sophisticated monetary policy. In 2007, Fed Chairman Alan Greenspan was hailed as a genius for managing the economy through multiple crises. Today, central banks have taken intervention to levels that would have been unimaginable in previous eras. They don't just cut interest rates anymore. They buy trillions of dollars in bonds. They purchase corporate debt. They promise to keep rates low indefinitely. They've convinced markets that crashes are simply not allowed anymore. But artificial stability always leads to stage 2. The warning phase. This is when cracks start appearing in the foundation. Not obvious cracks that everyone can see. Subtle fractures that only show up if you know where to look. In 1928, the warning signs were everywhere for those paying attention. Bank failures started increasing in rural areas. Corporate debt was reaching dangerous levels. The wealth gap was expanding rapidly. Foreign markets were already showing stress. But none of this made headlines, because everyone was focused on the stock market, which kept hitting new highs. The Dow gained another 27% in the first 9 months of 1929, right up until October, when everything collapsed. In 2007, the warnings were equally clear. Mortgage delinquencies were spiking. Banks were quietly tightening lending standards. The housing market was rolling over in key regions. Credit spreads were widening. Again, these signals were ignored because the main stock indices kept climbing. The S&P 500 hit an all-time high in October 2007, just months before the global financial system nearly imploded. Today, we're seeing the same pattern emerge. Corporate bankruptcies are increasing. Commercial real estate is under severe stress. Regional banks are struggling with underwater loan portfolios. Consumer debt is reaching breaking points. But just like in previous cycles, these warning signs are being dismissed because headline indicators still look strong. The stock market keeps hitting records. Unemployment remains low. GDP growth continues. Here's what makes the warning phase so dangerous. It creates false confidence. People see the warnings, but they also see markets continuing to climb. They conclude that either the warnings are wrong, or that the system has evolved beyond the old rules. This is the psychological trap that catches everyone. In 1929, sophisticated investors knew there were problems, but kept buying because prices kept rising. In 2007, bank executives understood the risks in their mortgage portfolios, but kept expanding because profits kept flowing. Today, institutional investors can see the imbalances, but they can't afford to miss out on the rally. Fund managers know valuations are extreme, but they have to keep buying to keep up with benchmarks. Everyone knows something doesn't feel right, but nobody wants to be the first to step away. The warning phase can last months or even years. That's what makes it so insidious. People get used to living with the contradictions. They convince themselves that maybe this time really is different. Maybe central banks really have figured out how to prevent crashes. Maybe technology has changed the fundamental rules of economics. But the warning phase always leads to stage 3. The trigger event. This is when something breaks that can't be fixed with more intervention. When confidence finally cracks. When the artificial stability collapses into real chaos. The trigger event is never what people expect. In 1929, it wasn't a single bank failure or economic report. It was a cascading series of margin calls that spiraled out of control. In 2008, it wasn't subprime mortgages themselves. It was the interconnected web of derivatives and insurance contracts that amplified losses throughout the global system. The trigger event doesn't announce itself ahead of time. It emerges from the same imbalances that created the artificial stability in the first place. Think of it like a dam holding back water. The pressure builds gradually, invisibly, until one small crack causes catastrophic failure. What makes trigger events so devastating is that they expose problems everyone knew existed, but chose to ignore. In 1929, everyone understood that buying stocks with 90% borrowed money was risky. But as long as prices kept rising, the risk seemed manageable. When prices started falling, those same leverage positions became weapons of mass destruction. In 2007, banking executives knew their mortgage portfolios contained questionable loans. Rating agencies knew they were stamping AAA ratings on garbage securities. Regulators knew the system had become dangerously interconnected, but profits were flowing, bonuses were massive, and nobody wanted to stop the party. The psychological element here is crucial. During stages 1 and 2, people convince themselves they can time their exit. They believe they'll see the crash coming and get out before everyone else. They think they're smarter than the market, more sophisticated than previous generations who got caught in bubbles. This overconfidence is exactly what makes the trigger event so brutal. When it finally arrives, nobody is positioned for it. Everyone is fully invested, maximum leverage, completely exposed. The smart money that thought it could time the market discovers that timing is impossible when liquidity evaporates overnight. So where are we now in this 3-stage sequence? The evidence suggests we're deep into stage 2, the warning phase. The artificial stability of the past decade is showing cracks that can't be ignored much longer. Consider what's happening in commercial real estate. Office buildings in major cities are trading at 40 to 50% discounts from their peak values. Regional banks hold hundreds of billions in commercial real estate loans that are underwater. But because these loans haven't officially defaulted yet, they're still carried at full value on bank balance sheets. This is exactly the type of hidden stress that characterized previous warning phases. The losses exist, but they're not being recognized. Banks are extending and pretending, hoping values recover before they're forced to mark assets to market. Sound familiar? The same dynamic is playing out in corporate debt markets. Companies borrowed trillions during the zero interest rate era. Now those loans are rolling over at much higher rates. Debt service costs are exploding just as economic growth is slowing. But companies are refinancing existing debt with new debt, kicking the problem down the road. Credit card delinquencies are spiking among lower income consumers. Auto loan defaults are rising. Student loan payments have resumed after a 3-year pause. Consumer spending, which drives 70% of the economy, is being supported increasingly by borrowing rather than income growth. Meanwhile, government finances are deteriorating rapidly. Federal debt service costs have tripled in just 2 years. State and local governments are struggling with pension obligations and infrastructure needs. But politicians keep promising more spending while refusing to acknowledge fiscal reality. These aren't abstract problems that might matter someday. They're live ammunition sitting in the financial system right now, waiting for a spark. And the spark always comes from wherever people are least prepared for it. The most dangerous aspect of our current situation is how confident everyone feels about their ability to navigate whatever comes next. Institutional investors believe they have sophisticated risk management systems. Central bankers believe they have unlimited tools to prevent crashes. Politicians believe they can solve any crisis with more spending and intervention. This overconfidence is precisely what makes stage 3 inevitable. When everyone believes they can handle any crisis, nobody prepares for the crisis that actually arrives. The trigger event succeeds because it attacks the one assumption everyone considered unshakable. In 1929, that assumption was that stock prices couldn't fall significantly because the economy was fundamentally sound. In 2007, it was that housing prices couldn't decline nationally because real estate was inherently local. Today, the assumption seems to be that central banks can prevent any serious economic disruption through monetary policy. But central bank intervention has limits that are becoming increasingly visible. When you've already pushed interest rates to zero, and bought trillions in bonds, what tools are left? When government debt is exploding and inflation is persistent, how much more can you print without destroying confidence in the currency itself? The Federal Reserve's balance sheet remains bloated at over $8 trillion. European and Japanese central banks own massive portions of their government bond markets. Chinese authorities are struggling to prevent a deflationary collapse in their property sector. The ammunition that saved the system in previous crises has largely been spent. This sets up a particularly dangerous version of Stage 3. When the trigger event arrives, the usual policy responses may not work. Interest rate cuts become ineffective when rates are already near zero. Fiscal stimulus becomes impossible when debt levels are already unsustainable. Bailouts become politically toxic when inequality has reached extreme levels. The pattern suggests we're closer to Stage 3 than most people realize. The warning signs are accelerating. The imbalances are becoming harder to ignore. The policy tools are approaching their limits, and most importantly, confidence in the system's ability to prevent crashes is reaching the kind of extreme levels that have always preceded catastrophic failures. History doesn't repeat exactly, but it follows rhythms that anyone can recognize if they're willing to look. The three-stage pattern that destroyed wealth in 1929 and 2008 is playing out again right now. We're not watching a rerun, but we are watching the same fundamental forces at work. The only question left is timing. How long can Stage 2 continue before something triggers Stage 3? How long can artificial stability mask growing instability? How long can intervention postpone the inevitable reckoning? The answer lies in understanding what triggers Stage 3, because it's never what the experts predict. In 1929, economists were debating whether the economy might slow down gradually. Nobody was preparing for a collapse that would wipe out 89% of stock values over 3 years. In 2007, the worst-case scenarios involved a mild recession and some housing market adjustments. Nobody was modeling for a global financial system on the brink of total breakdown. The trigger event always comes from the place where everyone feels most confident. In 1929, that was the stock market itself, which had been climbing so steadily that buying stocks with borrowed money seemed like free money. The leverage that made people rich on the way up destroyed them on the way down. In 2007, the trigger emerged from housing, the one asset class that Americans considered absolutely safe. Home prices had never declined nationally. Real estate was local. Location, location, location. Until it wasn't, and the entire global financial system discovered it was built on mortgages that couldn't be repaid. Today, the area of maximum confidence appears to be government debt, specifically US Treasury bonds. These are considered the safest assets in the world. Central banks hold them as reserves. Pension funds park money in them during uncertainty. When crisis hits anywhere on the planet, investors flee to US government debt as the ultimate safe haven. But what happens when the safe haven becomes the source of danger? US government debt has exploded from 10 trillion in 2008 to over 33 trillion today. Annual deficits run over 1.5 trillion during economic expansion. Interest payments alone consume nearly 1 trillion per year, approaching 20% of total government revenue. This trajectory is mathematically unsustainable. Yet markets continue treating US debt as risk-free. Interest rates on 10-year Treasury bonds remain historically low despite unprecedented borrowing. The assumption is that America can borrow infinitely because the dollar is the world's reserve currency, and the Federal Reserve can always print more money. That assumption is being tested in real time. Foreign central banks have been reducing their Treasury holdings for several years. China's Treasury portfolio has dropped from over 1.3 trillion to around 800 billion. Even allies like Japan have been quietly diversifying away from dollar assets. Meanwhile, the Federal Reserve owns nearly 6 trillion in government debt, purchased during various crisis interventions. This means the government is essentially borrowing from itself, with the central bank creating new money to buy bonds that fund deficit spending. It's an elegant circle until confidence breaks. The mechanics of a treasury market crisis would be unlike anything in modern financial history. When investors lose faith in stocks, they can flee to bonds. When they lose faith in corporate bonds, they can flee to government bonds. But when they lose faith in government bonds themselves, where do they go? Gold and commodities can absorb some flight capital, but not trillions. Foreign currencies become options. But every major economy faces similar debt problems. Bitcoin and cryptocurrencies remain too volatile and small for institutional flight capital. Real estate is already overvalued in most developed markets. This creates what market strategists call a liquidity trap, but on a global scale. When the ultimate safe asset becomes unsafe, the entire risk hierarchy collapses. Assets that seemed uncorrelated suddenly move together. Diversification disappears precisely when it's needed most. The psychological impact would be devastating because treasury bonds represent more than just investments. They're the foundation of the global financial system. Every bank uses them as collateral. Every pension fund relies on them for stability. Every central bank holds them as reserves. A crisis in the treasury market would be a crisis of confidence in the entire concept of modern finance. Here's what makes this particularly dangerous right now. The warning signs in the treasury market are already visible, but they're being ignored because they contradict everything investors believe about government debt. Auction coverage ratios have been declining. Foreign demand has weakened. The Federal Reserve has had to increase its purchases to ensure smooth auctions. These are subtle signals that most people don't understand or monitor. But they're the same type of early warnings that preceded previous crises. In 1928, rural bank failures increased months before the stock market crash. In 2006, subprime mortgage delinquency spiked, while prime mortgages still looked stable. The treasury market is showing stress in ways that would be obvious if this were any other asset class. Yields have been volatile despite Federal Reserve intervention. Liquidity has decreased during certain trading sessions. International demand has weakened even as domestic demand remains strong. But because everyone considers treasury bonds risk-free by definition, these signals get dismissed or rationalized away. Market participants convince themselves that temporary technical factors explain the volatility. They assume foreign selling is just portfolio rebalancing. They believe Federal Reserve buying is normal market support rather than emergency intervention. This cognitive dissonance is exactly what characterized previous warning phases. People see the evidence, but can't process its implications, because it contradicts their fundamental assumptions about how the world works. Banks in 1929 saw the rural failures, but assumed urban banks were different. Investors in 2007 saw subprime problems, but assumed prime mortgages were safe. The timeline for stage 3 depends on how long these contradictions can persist. How long can the treasury market show stress, while everyone pretends it's the safest market in the world? How long can the government borrow 6% of GDP annually, while investors demand historically low interest rates? How long can the Federal Reserve create money to buy government debt without destroying confidence in the currency itself? History suggests that contradictions this large don't resolve gradually. They build pressure until something snaps. The snap doesn't happen on schedule, but it happens suddenly when it arrives. One day everything looks manageable, and the next day the foundation cracks and everything built on top comes tumbling down. The most chilling aspect of our current situation is how perfectly it mirrors the psychology of previous pre-crash periods. Everyone can see problems, but everyone assumes someone else will solve them. Investors know valuations are extreme, but trust central banks to prevent crashes. Politicians know debt is unsustainable, but assume future growth will fix everything. Central bankers know their tools have limits, but believe they can innovate new solutions when needed. This distributed responsibility means nobody is actually responsible. everyone is relying on someone else to prevent the crisis that everyone can see coming. It's the perfect setup for stage 3, when all those assumptions get tested simultaneously and fail together. The pattern is clear, the timeline is accelerating, and the trigger mechanisms are already in place. We're not waiting for some external shock or unpredictable event. We're waiting for the internal contradictions of the system to reach their breaking point. And based on the historical pattern, that breaking point approaches faster than anyone expects, arriving precisely when confidence peaks and preparation is at its lowest. The 1929 crash began in October, when optimism was still running high. The 2008 crisis erupted when most experts still believed in the resilience of the financial system. The next crisis will follow the same script, emerging from the place where confidence is strongest and preparation is weakest. All the pieces are in position. The pattern is completing itself once again. The 3-stage pattern has played out twice before with devastating precision. Artificial stability, warning phase, trigger event. We've documented how it destroyed fortunes in 1929 and 2008. We've shown how the same sequence is unfolding right now, stage by stage, warning by warning. The only variable left is timing. But if history teaches us anything, it's that when everyone believes crashes can't happen, that's exactly when they do. The pattern never lies, and the pattern says we're running out of time.